Hello and welcome to my channel, where I talk about the latest news and trends in the world of finance and investing. In today's video, I'm going to explain how the Federal Reserve's tapering and rate hike plans affect the bond and stock markets. Now, let's get started. The Federal Reserve, or the Fed, is the central bank of the United States. It has a dual mandate of promoting maximum employment and stable prices in the economy. To achieve these goals, the Fed uses various monetary policy tools, such as setting the federal funds rate, which is the interest rate that banks charge each other for overnight loans, and buying or selling government bonds and mortgage-backed securities, which are known as asset purchases or quantitative easing, QE. Since the outbreak of the COVID-19 pandemic in early 2020, the Fed has taken unprecedented actions to support the economy and financial markets. It slashed the federal funds rate to near zero in March 2020 and launched a massive QE program of buying $120 billion worth of bonds per month. These measures were intended to lower borrowing costs, stimulate spending and investment, boost asset prices, and provide liquidity and stability to the financial system. However, as the economy has recovered faster than expected from the pandemic shock, thanks to the widespread vaccination and fiscal stimulus, the Fed has faced growing pressure to start normalizing its monetary policy. The main reason is inflation, which has surged to its highest level in 4 decades. According to the Consumer Price Index, CPI, rose by 6.8% year-over-year in November 2021, the highest since June 1982. The core CPI, which excludes food and energy prices, rose by 4.9%, the highest since November 1991. The Fed has attributed the inflation spike to transitory factors, such as supply chain bottlenecks, labor shortages, pent-up demand, and base effects. It has also argued that inflation expectations remain well anchored and that inflation will moderate as these factors fade over time. However, some Fed officials and market participants have expressed concerns that inflation could become more persistent and entrenched, especially if wage pressures increase and demand continues to outstrip supply. Therefore, the Fed has decided to start reducing its asset purchases or tapering its QE program. In November 2021, it announced that it would reduce its monthly bond buying by $15 billion starting in December 2021, with $10 billion less in Treasury securities and $5 billion less in mortgage-backed securities. This would bring its monthly purchases down to $105 billion. In December 2021, it announced that it would accelerate its tapering pace by doubling the amount of reduction to $30 billion starting in January 2022, with $20 billion less in Treasury securities and $10 billion less in mortgage-backed securities. This would bring its monthly purchases down to $75 billion. At this pace, the Fed expects to end its QE program by March 2022. However, it also reserves the right to adjust the pace of tapering depending on the economic outlook and financial conditions. The Fed has also signaled that it is ready to start raising interest rates sooner than previously anticipated. In its latest economic projections released in December 2021, it indicated that it expects 3 interest rate hikes in 2022, followed by 3 more in 2023 and 2 more in 2024. This would bring the federal funds rate up from near zero to 2.125% by the end of 2024. This is a significant change from its previous projections released in September 2021, when it expected 1 interest rate hike in 2022, 2 more in 2023, and 1 more in 2024. This would bring the federal funds rate up to 1.375% by the end of 2024. The Fed's projections are based on its assessment of the economic outlook and the risks to its dual mandate. The Fed has upgraded its forecasts for economic growth, inflation, and unemployment for 2021 and 2022, reflecting the strong recovery and the progress on vaccinations. However, it has also acknowledged that there are still downside risks from the Omicron variant of the coronavirus and other sources of uncertainty. The Fed's decisions on tapering and rate hikes are not predetermined or mechanical, but rather depend on the incoming data and the evolving conditions. The Fed has emphasized that tapering is not a signal for rate hikes, and that there is no mechanical link between the two. The Fed has also reiterated that it will use a flexible and forward-looking approach to adjust its policy stance as appropriate. So, how do these Fed actions affect the bond and stock markets? Let's take a look at each market separately. The bond market is directly affected by the Fed's actions, as they influence the supply and demand of bonds, as well as the expectations of future interest rates and inflation. Generally speaking, when the Fed tapers its bond purchases, it reduces the demand for bonds, which lowers their prices and raises their yields. When the Fed raises interest rates, it increases the opportunity cost of holding bonds, which also lowers their prices and raises their yields. However, the bond market reaction also depends on how the Fed communicates its policy intentions and how the market interprets them. If the Fed surprises the market with a faster or slower pace of tapering or rate hikes than expected, it can cause volatility and uncertainty in the bond market. If the Fed reassures the market that it will act gradually and cautiously, it can reduce volatility and uncertainty in the bond market. For example, in May 2013, when then-Fed Chair Ben Bernanke hinted at tapering QE for the first time, it caught the market off guard and triggered a sharp sell-off in bonds, known as the taper tantrum 2. The 10-year Treasury yield jumped from 1.66% to 2.98% between May and September 2013. However, when the Fed actually started tapering in December 2013, it did so in a predictable and transparent manner, which calmed the market and stabilized bond yields. Similarly, in November 2021, when the Fed announced its tapering plan, it did not surprise or shock the market, as it had prepared the market well in advance with clear guidance and signals. The 10-year Treasury yield barely moved from 1.54% to 1.55% on that day 3. However, in December 2021, when the Fed announced its accelerated tapering pace and more hawkish rate projections, it did surprise some market participants who expected a more dovish stance given the Omicron risk. The 10-year Treasury yield rose from 1.42% to 1.46% on that day. The stock market is indirectly affected by the Fed's actions, as they influence the cost of capital, the earnings growth, and the valuation of stocks. Generally speaking, when the Fed tapers its bond purchases or raises interest rates, it increases the cost of capital, which reduces the present value of future earnings and dividends, and lowers the valuation of stocks. However, the stock market reaction also depends on how the Fed's actions affect the earnings growth and the risk premium of stocks. If the Fed's actions are seen as supportive of economic growth and financial stability, they can boost the earnings growth and lower the risk premium of stocks, which can offset or outweigh the negative impact of higher interest rates. The stock market reaction also varies across different sectors and industries, depending on their sensitivity to interest rates and economic cycles. Generally speaking, sectors that have high debt levels, long-term cash flows, or low growth prospects tend to underperform when interest rates rise, as they face higher borrowing costs, lower present values, or lower relative attractiveness. These sectors include utilities, real estate, consumer staples, and healthcare. On the other hand, sectors that have low debt levels, short-term cash flows, or high growth prospects tend to outperform when interest rates rise, as they face lower borrowing costs, higher present values, or higher relative attractiveness. These sectors include financials, energy, materials, and technology. For example, in 2018, when the Fed raised interest rates 4 times by a total of 1 percentage point, the utilities sector was the worst performer in the S&P 500 index with a return of -4.1%, while the financial sector was the best performer with a return of 13.1%. How can investors respond to Fed actions? Investors who want to navigate the Fed's actions and their impact on the bond and stock markets should consider the following strategies. Diversify across different asset classes, sectors, and geographies to reduce exposure to interest rate risk and benefit from different sources of return. Monitor the Fed's communication and guidance, as well as the incoming data and market expectations, to anticipate potential changes in monetary policy and adjust portfolio accordingly. Focus on quality and value, rather than chasing yield or momentum, to avoid overpaying for risky or overvalued assets that may suffer from a reversal or correction. Seek opportunities in sectors or industries that may benefit from higher interest rates or economic growth, such as financials, energy, materials, or technology. Hedge against inflation risk by investing in assets that tend to perform well in inflationary environments, such as commodities, real estate, or inflation-linked bonds. To sum up, the Fed's tapering and rate hike plans are important drivers of the bond and stock markets, as they affect the supply and demand of bonds, as well as the cost of capital, the earnings growth, and the valuation of stocks. However, these effects are not uniform or predictable across different asset classes, sectors, or geographies. Therefore, investors need to be aware of how these Fed actions influence their portfolios and adjust their strategies accordingly. That's all for today's video. I hope you learned something new and useful. If you did, please give this video a thumbs up and share it with your friends. And don't forget to subscribe to my channel for more videos like this. Thank you for watching and see you next time.